As of February 2026, U.S. national debt stands at roughly $38.7 trillion. That's not just a headline number, it's a structural shift in America's fiscal future.
About $31 trillion is debt held by the public. Another $7.6 trillion is owed internally within the government. According to the Congressional Budget Office, debt held by the public equals 101% of GDP in 2026. After World War II, the peak was 106% in 1946. But today, the real concern isn't just size. It's rising interest costs that are beginning to erode the federal budget. In 2026, interest payments are projected to exceed $1 trillion. That's more than national defense. As interest rises, it consumes a larger share of the budget, and other programs get squeezed. Social Security costs about $1.2 trillion in 2026. The trust fund may become insolvent between 2033 and 2035. Benefits could automatically fall by 21 to 25%. That means retirees could lose $300 to $500 per month. Retirement age may rise, payroll taxes may increase. Medicare and Medicaid total roughly $1.3 to $1.4 trillion. Healthcare costs rise 5 to 7% annually. If budgets tighten, access shrinks. Education is often the easiest target. Funding could decline 10 to 20% after inflation adjustments. Infrastructure spending may fade as the 2021 law phases out. 45,000 bridges remain structurally deficient. Rising interest costs trigger a cycle. Less investment, slower growth, lower tax revenue, more debt. This is the spiral warned about by the CBO and the Committee for a Responsible Federal Budget. If this feels more complex than headlines suggest, share this video with someone who cares about economic reality. In 2026, the government will borrow roughly $1.9 trillion. By 2036, that could exceed $3 trillion. When supply of treasuries surges, yields must rise to attract buyers. Today, the 10-year yield sits near 4.1%, far above pre-pandemic levels. Treasury yields anchor the entire credit system. A half-point rise could push 30-year mortgages towards 6.6 to 6.8%. A $400,000 loan could cost $130 to $160 more per month. Auto loans, student loans, corporate bonds all become more expensive. CBO projects debt rising from 101% of GDP in 2026 to 120% by 2036. Growth slows from 2.2% to about 1.8% annually. Over 20 years, that gap compounds into trillions in lost output. Debt is not abstract. It becomes a hidden tax on wages, homes, and opportunity. A technical default is unlikely. The U.S. issues debt in its own currency and controls the global reserve. But confidence matters. If major investors demand higher yields, markets can react violently. CRFB warns of multiple crisis paths: sudden rate spikes, recession, inflation, credit stress. Not certain, but the probability rises. $38 trillion is not an immediate collapse. But rising interest, shrinking investment, and slower growth form a ticking time bomb. By 2036, much of the federal budget could be consumed by interest and aging-related programs. If you value deep analysis grounded in CBO data rather than headlines, subscribe now. Understanding debt may be the greatest financial edge you can have.